động cái giờ nào đi học rồi.
Sao vậy?
Cái anh sẽ thấy thầy giáo ở đây không thế nào.
Sao vậy?
Định nghĩ rồi.
Không đi học bên môn đúng không? Quay lưng cho thầy đỡ mỏi cổ.
Đúng rồi.
Yeah, thanks again for the very nice dinner yesterday. That was really great. You know, when you come here all the way, of course you want to see, well, you want to do more than just speaking in front of the class and then talking with you, the best speaking English proficiency people in Vietnam. That's the best for us to exchange. Also some traveling on the weekend and also one reason why we come. And that makes our stay really enjoyable. And I look forward to see some of you hopefully also soon in Frankfurt. By the way, Fabian, I think just has landed on the airport and he brought his wife with him. So you can basically get two if you like. Morena is the name of his wife and she's a lawyer, by the way. No, she's not only a lawyer, she's a judge. Yeah, so she can send you to prison if you're in Germany. Let's go back directly where we ended yesterday. So basically we said if taxes basically is an advantage to debt, then there must be something that prevents firms to go for 100% debt, and that the obvious first guess is that that must be bankruptcy. And if you include bankruptcy like this, you basically have no effect of bankruptcy. Because this kind of bankruptcy simply means if you have a firm that has all equity, and there was 150 and 80, think of the apple tree as a firm. When the weather is good, there were 150 apples, and when the weather is bad, there were only 80 apples. And this is what you distribute to your shareholders. So debt receives nothing because there is no debt. Equity investors receive these 150 and 80. And that's basically the amount of apples that you pay out to the capital market. And if you have leverage, and basically you say, if in the success case, 100 apples belong to the bondholders, simply because they have a bond that entitles them to a repayment of 100, and then the rest is paid to equity holders, and we have again 150. If there is a failure, the firm is not able to pay back these 100 apples, the debtors in insolvency basically take over the firm, sell the apples, and basically receive 80. And of course, what the capital market investors receive is the same. And therefore, the usual logic applies. The price of equity plus the price of debt, these two instruments should equal the price of this all-out equity firm. So bankruptcy itself, the possibility that the firm is not able to pay back its debt holders is not any disadvantage to debt. It's rather a different division of the apples. Think about the firm as a big cake, and leverage capital structure basically says who receives how many apples or which piece of the cake, and so it's just a division rule of the cake, but not making the cake larger or smaller. And only if the cake becomes larger or smaller, and then capital market investors basically have a reason to change the overall price of the firm. Now, there is empirical evidence that bankruptcy costs are, of course, are not trivial. In our example, there was zero bankruptcy costs. The firm was simply handed over to the debt owners, and then the debt owners received the assets. But at Outland, actually, very important, they estimated 20% of the firm value is often exceeded, and on average is something like 11 to 17%, up to 3 years prior to bankruptcy. And that's important. When we think about bankruptcy, we think about the lawyers and the trustees that basically work on the case, and they receive salaries, and that's basically something that eats up some apples. But the bigger effect is, think about VinFast. Would you buy a VinFast when you believe that VinFast will go bankrupt in the next years? Probably not. You will choose another car manufacturer. So if customers rely on long-term survival of the firm because they want spare parts when the car breaks down, then of course the real cost is that VinFast may be able to sell less cars if it is in a situation where people say it is likely to go into bankruptcy. And if we introduce this into the model, then we simply assume the same as before. If there is no debt, then it is 80 or 150, depending on the weather. And with the debt, they will be forced into bankruptcy if only 80 million is received, of course. And let's assume that the debt holders that receive less than 80 million, let's simply assume that they receive 60 million. And this is basically a direct bankruptcy cost that we model here. And then, of course, it's easy to see that this amount of cash flows and this amount of cash flows is, of course, less. So, maybe Danny Miller does no longer hold. And, of course, this firm will not basically treat 100% debt as the optimal capital structure. Now, yesterday I talked to an engineer in the afternoon, and basically engineers, when they do academic research or science, they teach the people what is the optimal degree of, for example, fertilizer to bring on the field. Every decision basically has an optimum amount. Too little fertilizer is bad, too much fertilizer is also bad, and actually academic research should tell you precisely how much fertilizer to bring out. And in this example, you would expect that economic theory tells you, take this data from the company, calculate the model through, and then the result is maybe 50%, maybe 70% is the optimal debt level. Unfortunately, this is not how business and finance research is. In the whole book, you will not find anything like if you have a company like VinFast, and VinFast has high indirect bankruptcy costs as discussed, then the optimal tax level, traded off with the tax benefit, is something like 50%. Business people, many people think that bankers or business experts know precisely what to recommend and what kind of leverage ratio is good. Unfortunately, our books do not give us precise formulas on how to do this. Of course, you could easily make a model with some additional assumptions that basically would turn an optimal leverage ratio that you can calculate. But we see them more or less as pedagogical instruments to teach our students what to think about. We actually don't believe that these models really explain a real-world firm situation like VinFast. And therefore, it is amazing that something so applied as finance, we teach about capital structure, we teach the students about what to think about, but in the end we don't teach the students models that they can apply or they can go out to VinFast and basically calculate the model through and then give a precise recommendation. So we are not like engineers. We are basically more or less like distant academic researchers who basically think that companies like VinFast that produce cars, because they have high indirect bankruptcy costs, will probably have reasons to have a lower leverage ratio as compared to other companies that do not have this high indirect bankruptcy costs. That's basically everything that we do. And also in the research, when we test this hypothesis, basically we try to distinguish two groups with high and low bankruptcy costs, and we just investigate whether they indeed have different leverage ratios. And then we say this is support for this theory, but far away from basically giving precise recommendations to the people. And then of course you may ask who pays the cost of financial distress. if you just look at this, of course, if you're a debt holder, you are going to receive either 100 or 60. So if you think about this is obviously the present value of the debt. If you assume that there was a 50% probability, this is what they get. And by assumption, this is what the bond promises to be paid. So this is basically 80 divided over 1 plus R. Now let's assume, just assume that 1 plus R is the interest rate is 10%, then this is something like 7.2 or so. And sorry, roughly $72. So if you think about what is the amount of money that the equity owners can raise in the beginning, the bondholders will say, this is our claim, which has a present value of roughly $72. So basically we pay $72 for this bond. And this would be the price of the bond. And this would be the amount of capital raised. The equity owners basically have to set up the firm. They have paid this amount from the bondholders. They have to invest the rest in forms of equity. Now, one thing is clear: if you would basically have an 80 here, then this would be 90, and 90 divided by 1 plus 1 would be something like 8.8 or so, and we would have a higher price. So the first observation is, when the debt holders suffer from default, it is actually the equity owners who suffer, because they receive only 72 instead of 88 from selling the bond. So ultimately, in finance it is always that when debt holders want a return of 10%, when they do this calculation, they will simply adjust the purchase price of the bond, and then ultimately the equity owners are the ones who suffer. Bankruptcy comes at a cost or implies a loss for the bondholders. But of course, the bondholders have fairly priced bonds. By simply adjusting the price of the bond that they pay, they will basically make sure that they receive 10% on average. You can't basically make the bondholders worse off. And then the ultimate cost is paid by the equity owners. They have to put more money on the table in order to establish the firm. And by the way, which is the interest rate of debt, if you think about you will borrow, let's say, 72, you pay back 100, then the loan interest rate is the following. If you solve this question, of course, then you will see the interest rate of the loan. The loan contract will basically be, you borrow 72, the bondholders or the bank provides $72 to the bank. Yeah, then in the contract we will have an interest rate stated. Yeah, and of course the interest rate in the loan is such that $100 will be repaid at maturity. Yeah, when we simply say $100 will be paid, yeah, that's of course a slight simplification, because in the real world, bond contracts are, they have a notional amount, here it is 72, and they have an interest rate, yeah, and then both these variables basically imply the payments to be done, yeah, and 100 here is just a simplifying assumption. Yeah, and then of course we will realize that this interest rate goes up and down depending on whether you put an 80 or 60 in here. Yeah, so banks or bondholders in the end will charge a higher interest rate if there was a higher risk for them. Yeah, and they will also, yeah, and their pricing will always be such that they on average get 10%, whatever their cost of capital is. Yeah, and all the economic losses, yeah, the welfare losses, yeah, the fact that there were fewer apples to be distributed to the capital market, yeah, the ultimate costs are borne by the equity owners, yeah, simply because the bond owners always make 10%. Yeah, and they will adjust the price. Yeah, in competitive, yeah, if 10% here is the correct cost of capital, yeah, then under competitive conditions, yeah, you will be able to raise at an effective cost of 10%. Yeah, so 10% is what the bondholders earn. Yeah, and if there is no benefit or damage, whatever, for the bondholders, they receive an average 10%. Full stop. Yeah. And the assumption, of course, of all this modeling here is everybody knows everything. Yeah? It is known to everybody that there is a 50% probability of default, yeah, and what the financial consequences of the default are. Yeah? And this is, of course, a very, very strong assumption. Yeah? If you think about VinFast, yeah, where should you know what the probability of a default of VinFast is? Yeah? And where should you know how many dong or euros or dollars they still have in bankruptcy? Yeah, it's highly uncertain. Yeah? And that's one of the reasons why we can make nice models, yeah, but they are not applicable in the real world. Yeah? You can't use them to do a model on VinFast. Yeah? So, one thing is clear, if the new product fails, yeah, if we have only 80 realized, yeah, then the equity holders lose their investment, the firm is bankrupt. And for them, they basically initially don't care whether it's 80 or 60. It's not their problem. Yeah? They are out of the game anyway. Yeah? But debt holders understand this, and they will pay less for the debt initially. Yeah? They will pay only 72 instead of 88, or whatever the calculation is. Yeah? And so basically, the equity owners must put more table on the table in order to establish the firm. And then, when securities are fairly priced, yeah, and this is an example of fairly priced debt, yeah, then basically it's always the original shareholders, yeah, who pay the present value of the costs associated with bankruptcy. Yeah, this reduction of 80 to 60, yeah, is basically their damage, and therefore the equity owners will think about, yeah, how to change this. And one change is, of course, if you say, I put in 80, yeah, then there is no reduction. Yeah, 80 can be always paid. Yeah, there will not be a bankruptcy. Yeah, and then you prevent this kind of effect. Yeah, and equity owners, of course, would be better off by limiting the amount of debt to 80. Yeah, so the textbooks basically say, if we think about the value of a leveraged firm, at this point of time, yeah, we would think about the value of the unleveraged firm, and then there was some additional, yeah, the present value of the tax shield, yeah, that we calculated yesterday, at least in one easy example, permanent debt, yeah, the same tax savings in every year into the future, and then we can easily use the Gordon growth formula for this. Yeah, and then of course we have to subtract the present value of financial distress, and think about this kind of calculation in order to do so. And that would then be optimized. And in a richer model, of course, you could somehow calculate the optimal debt level, but it doesn't make a lot of sense to basically make this model richer and then really calculate the optimal capital level, simply because the assumptions of the model are so abstract that it won't really help us. So we leave it really with this formula, and then basically only think about the implications of this theory. So the present value of financial distress cost is clearly affected by the probability of financial distress. Here it is this 1/2. If it would be only 1/4, the things would change. The magnitude of the cost, if the is in distress, so this is basically the delta. How much is taken away in the case of bankruptcy, and the appropriate discount rate for the distress cost. And here we basically assume that the debt totals have 10% cost of equity, but of course this debt is risky, and there should be risk premium in there. And if you have only 80 in debt, 80, and you say now debt is risk-free, then you would assume that also this here is the risk-free rate. Once debt becomes risky, you would assume that debt totals demand a higher interest rate. Because now they are a bit like shareholders, and they have to think about the risk premium. So in the capital market, a fair risk premium would be priced. And it's the three things that really should affect the leverage decisions, because they affect the probability of bankruptcy costs. And then the theory can be used in order to do some easy empirical implications. For example, real estate firms that mainly own houses, and these houses are rented out to residents or to business. Their assets can be sold easily. There is and their assets can be sold without, easily means basically without large stress costs. If the value is 80, then you can sell it for 80. And then this kind of reduction here is most likely to be smaller. And from the viewpoint of the theory, it is the easiness to sell the assets that make real estate debt finance relatively attractive. And of course, in reality, we observe that real estate firms have much more debt than other firms. Traditionally, well, the traditional explanation is there is collateral. The house serves as the collateral for the loan, and therefore this gives additional security for the bondholders. But this theory basically tells, no, the real reason is a different reason. The real reason is that this delta here is relatively small. Suppose you have an industrial factory that produces something, like these plastic bottles. And of course this machine is highly specialized, you need skilled workers to do this. If bondholders receive this machine, they don't know what to do with it. And they will likely sell it at discount prices. And then think really about the beta of distress costs. Think always think in the terms of the CAPM. The cost of capital is the risk-free rate of capital plus a risk premium. And the risk premium depends on the beta. The bigger the amount of risk, measured by the CAPM in terms of exposure to market risk, the bigger the risk premium will be. And also this plays a role in here. So the textbook basically believes that the value of the firm function of B to E. Yeah, it's first going up and then going down, and of course this is the optimal level. Yeah, it's only that we don't know precisely where this level is. Yeah, but we believe if there was no leverage, if you go from here to here, yeah, basically you enjoy the tax benefit, yeah, but you're so far away from bankruptcy, yeah, that the negative effects of bankruptcy are not yet visible. Yeah, if you go from here to here, you have the same additional tax savings, yeah, but now you have substantially increased bankruptcy costs. Yeah, so on the right hand side, the firm value goes down, on the left side it goes up, yeah, and there must be an inner optimum somewhere here, and then we would call this then the optimal capital structure. Yeah, but again, without having a fully formalized model, yeah, that can be calibrated with empirical data, yeah, that would be nice to have, but we do not. Yeah, and as I said, this is what we can explain. Oh, there it is. This nice thing. Okay. Now we come to the next chapter, and we dive into a completely new area. And that is called agency costs. What we had so far, we have the benefits of debt, the cost of bankruptcy, was a theory that has been developed maybe in the 60s, roughly 60 years ago. And this kind of theory was actually born in the 80s. And modern finance theory basically is starting with a completely different viewpoint, and in the center of the limelight are really what's the so-called agency costs. We had if you read here what Adam Smith is the godfather of all modern economics. Yeah, he wrote the first economics textbook ever in 1776. And he was the first to basically point to, I hope you still remember, because after the crisis, then back in 1933, we had this Earl and Means book that basically explained that the separation of ownership of control is the reason. Yeah? Directors make the decision, or managers make the decisions, yeah, but shareholders bear the risk. And this is what we call separation of ownership of control. And yeah, today we basically call this agency conflicts between the stakeholders, the shareholders, and the managers of the firm have different objectives. Yeah, the manager does not want to work hard, but the shareholder wants him to work hard. The shareholder wants him to invest only in positive NPV projects, but the manager may be interested in empire building or taking over other firms just in order to prevent to be taken over himself, and that kind of things. And actually, the first textbook ever in economics already quoted this. The directors of such companies, so these are the managers, they are the managers of other people's money. Other people's money is a very famous buzzword for basically introducing something with agency conflicts. It cannot be expected that they watch with the same anxious diligence over their money. So basically they do not exercise the same degree of effort and diligence in order to do their job. So negligence and profusion must always prevail in these companies. So negligence basically means the manager do not care. They more enjoy their private life, they do not work hard, and then basically make sure that the money is well invested. That's what Adam Smith told. And this is, and the question is then, what kind of problems come from this kind of agency relationship and what is the function of leverage. Now the modern finance theory of agency costs really started in 1976, and it was Michael Jensen and William Beckley, and people of my age, basically all over the world, read this article. It is brilliantly written. It's not mathematical. It's just maybe reasoning, and very forcefully, they basically said, this separation of control. They call it separation and control. So it's called the right word is the separation of ownership and control. Let me write this down. The real problem is that there is a separation of ownership and control. And with ownership, we basically mean the shareholders, and with control, we mean the managers who control or who make decisions. And because they are separated, they are different people, and we have a problem. Elon Musk is both the owner and the manager of Tesla. And when he does risky decisions, he basically knows that he will suffer himself from this. If there is a large bankruptcy corporation, there is no separation, you decide on your own level. But suppose that somebody else decides on the risky projects of Tesla, then he basically may have other reasoning, other objective functions. So let us assume that management will generally make decisions, hopefully, they will increase the value of the firm, but when the firm is leveraged, managers may make decisions that benefit shareholders and harm the firm's creditors. Okay, now we have to think about two more things. There were two famous conflicts of interest. If you just think about managers and shareholders, then we think about managers being empire builders or being lazy, and shareholders basically bear the consequences. And secondly, between creditors on the one hand side, and I would call this manager plus shareholders, or creditors and equity. Suppose these here are one group, and we call them equity. So we think about Tesla. Elon Musk is both the owner and the manager. But there is still a second party, and this is creditors. And they make decisions that have consequences on their well-being. And so these are the two classical agency conflicts that we have in today's firms. And Jensen and Meckling in this article basically have two sections on both areas, and they argue that that these incentive conflicts shape, basically they write in this article, shareholders need to incentivize managers or to monitor managers. If there is a conflict between managers and shareholders, then shareholders should find some way to incentivize managers. For example, they pay with stock options, and then the manager has an interest to increase the stock price, and that aligns the interest of both groups. or shareholders find some way to monitor the actions of management and then penalize the manager, replace them with new managers if they find a deviation from the behavior that they want to see. And this is not the thing here. What we What we look at today is only this complex. So we think that managers and shareholders do not have a conflict of interest. They act as one party. They are the equity owners. And we implicitly think about a corporation like Tesla, where we don't have this separation of ownership of control, because Elon Musk is both the owner and the manager, but still we now have a conflict with the creditors. And we think of kind of wrong or bad decisions may result out of it, and how capital structure may solve this. And the idea is capital structure is basically the solution to optimizing this kind of interest, of conflict of interest. So let's again start with a very, very simple example. Baxter Industries has 1 million of debt, so 1 million is basically this amount of money that has to be paid. And the value of assets will be 900,000 at that time, given the today's strategy. So the firm currently has a strategy that has no risk at all. 900,000 with probability 1 and nothing else. And of course, the firm knows if they do nothing, then this will be the result. The firm will end in bankruptcy. The debt holders will receive 900,000. The equity owners will receive nothing. Suppose you are Elon Musk. This is your firm. What can you do? You basically, if you do nothing, you will lose everything. The firm will go under. And there was a nice word. Gamble for resurrection. It actually comes from the banking theory. Banks are quite often in that situation. A banker may have a large and very nice bank, and he looks at all his numbers and basically comes to the conclusion, if I do nothing, my bank will soon be bankrupt. And my life is over. As a banking director, I will be fired and become unemployed. And then gambling for resurrection actually means the banker will do everything to at least create a small probability of being rescued. And gamble means a high risk, a high speculation. In that situation, the banker will simply take the rest of the money that the bank has, go to the stock market and have a high risk bet. If he wins, the bank is rescued. But if he loses, of course, the loss will be even larger. That is the idea of gambling for resurrection. And in the banking literature, this is one of the main reasons why banks are regulated and why banks are forced basically to have enough equity capital in order not to get into this area. Because when banks start gambling, that is obviously a high risk for the society. The depositors lose their money, and therefore the regulators will actually have an eye on this. And this example here will be exactly the same thing. So this is also a firm that is facing bankruptcy and excessive risk taking. And asset substitution is just another word for it. Suppose you have an asset that now produces 900,000 for sure. You replace this by a new asset that is more risky. That is substitution. You substitute the old asset for a more risky asset. And so excessive risk taking and asset substitution is basically the whole thing. So the new strategy is that there is no upfront investment. Maybe you simply sell your existing machine and you replace it with something else. And the new machine basically has 1.3 million or 300,000 as the outcome. Let's assume 50% probability. Then of course on average it's only 800,000. So from a welfare point of view, that's clearly not a good decision. The expected outcome is less, and there is more risk. Investors hate risk, and they love profits, they love high values, so this is clearly nothing that the capital market enjoys. And for Baxter, of course, with the shareholders, they benefit. If you think, here is the equity, here is the creditors, do the equity holders benefit from it? Surely, because under the old strategy, they receive 900 for sure, this goes to debt, and equity owners get 0. Under the new strategy, if the 300 is realized, of course the firm is also bankrupt. But if 3,200 is realized, they can pay back the debt, and 300 is left over. And from the management point of view, of course, it's even better because the firm is not dead, the firm continues to run, the manager can keep his job. So, equity holders prefer this, and if they are in this situation, and if they are allowed to do this, they will do it. And you can basically learn a lot of things from this. If you are the bank or the bondholder, you want to prevent this. And one way to prevent this is this old asset here, a machine, that is currently worth 900,000, that could be pledged as collateral in the contract, like your house. If you have a mortgage loan, then you pledge your house as collateral, and of course you must not, or you cannot sell your house and replace it with a stock portfolio, with some risky investment. Simply because pledging something as collateral means that you have to ask the bank for permission in order to sell the house. Or if you sell the house, the bank immediately can ask you to pay the money back. The mortgage loan is based on the assumption that you have a house. This house basically serves as collateral for the loan. And by pledging it as collateral or by writing into the debt contract, once the house is sold, you immediately have to pay back the loan, then you can prevent this. But in many examples, the contractual protection for bondholders or for the bank is not as easy. Think about Tesla. They have all kinds of different machines. They have all kinds of different investment projects. Some are more risky, some are less risky. It is almost impossible to write precisely in the contract what Tesla has to do with the money that they receive from the bondholders. And then we talk about a situation where we call this incomplete contract. This incomplete contract, we basically say it is impossible to write a contract that has all the contingencies, all conditions of the world, and I would say, if we are in that situation, then Tesla is allowed to do this and this strategy. All these things cannot be fixed in the contract. And that leaves a lot of freedom to Tesla, basically to increase the risk, if they want to. And that's of course typical for almost all debt contracts. The mortgage contract, where the house is pledged as collateral, is a nice but very special case. And you don't see this kind of thing for other companies. So equity holders gain, although it has a negative expected payoff for all investors involved. And of course, debt holders lose. If you think about the debt holders, of course, the risky debt expects only to receive 650, down from 800. So basically they lose 150 and they gain 150. The 600. Sorry. Okay. The old strategy has an overall payoff of 800, and the new strategy has an overall payoff of only 800. So it's clearly not in the interest of the capital markets to do this. What would debt holders do? Of course, they would basically look at this and say, if we get into this kind of situation, we have to adjust our interest rate of the debt. So when we basically say how much money do we put on the table up front, or what is the debt rate of the loan, we will adjust this upwards, and then in the end we conclude again. But ultimately, the equity owners pay for this. If the equity owners could commit ex ante to not do this, then of course the debt holders would be secure to receive their money back. But given that you can't write a contract, you have an incomplete contract that cannot rule out this kind of behavior, then debt holders will anticipate this bad behavior, they will charge a higher interest rate for their debt, and the equity owners basically are worse off. So, so this slide basically says that equity owners will do this risky strategy simply because in this situation when they have the choice, would I gamble for resurrection, will I increase the risk or not increase, they will just look at what is the profit for me. And of course the profit for them is 150,000 and the debt holders basically bear the cost. So equity holders are effectively gambling with debt holders' money, and can't prevent this. So the conclusion is when the firm faces financial distress, when it is coming to a situation like this, shareholders can easily gain at the expense of debt holders by taking a negative NPV project. This is a typical example of a negative NPV project. Instead of 900, it's worth only 800 on average, and it's risky. It would never be financed upfront. If you go to the capital market and say, I have a great idea, I want to establish a new firm, this is my investment, nobody would finance this because it destroys value rather than increasing value. But shareholders have an incentive to engage in these negative NPV projects. And of course, this is anticipated by debt holders, and the security holders and the debt holders will pay less. So this price here will adjust, or in a way we can basically say the bank will charge a higher interest rate. Of course, the bank will also, at least in our models, the bank will also always receive what they want to receive, this 1.1%, and then ultimately it is the equity owner who pays for it. So this firm, if this is Tesla, and if this is a problem anticipated by all, then Tesla will pay a much higher interest rate on the debt as necessary, and the share price of Tesla is reduced simply because this kind of possibility exists. And there is anticipation of this by the debt holders. So the bondholders basically pay less, and the equity owners bear the risk. So this was one easy example called gamble for resurrection, or asset substitution, or excessive risk taking. It's just three different words for the same thing. And the idea is always, you engage into projects that actually destroy value, that have a negative net present value. You do so for obvious reasons, because equity owners profit from this. And if debt holders anticipate this, basically you are worse off. You would like to write in a contract, this is forbidden, because then you pay less of interest rates, but it is impossible. By the incomplete contract assumption, you can't write this into the contract. And now we have another agency cost. So asset substitution is one agency cost that comes with excessive debt. If you have too much debt, then this is the problem. Basically, the theory tells us that if you go from here to here, you have only tax benefits, but you do not yet have gambling for resurrection problems, but if you go from here to here, you basically say the tax benefits are still increasing, but now we come into a region where excessive risk-taking becomes a problem. And therefore, debt holders will protect, charge you a very high interest rate, and then maybe you don't go from here to here, and you stay with the optimum. It's just an argument why firms do not continue to increase the debt in order to exploit the tax benefits of debt. And underinvestment in a debt overhang situation is just another reason. So agency conflicts are plentiful. You can basically think about many circumstances or cases where this kind of thing can be a problem. And the idea is really you have a positive NPV project and you don't do it. So the last example was a negative NPV project and you have incentives to do it, although it destroys value. We have exactly the opposite. A firm that is in a high debt situation, and because of the high debt, it is not doing what investors like. Investors basically want to realize all positive NPV projects, but we will see shareholders will basically say no to this, and then of course the firm value is less than it would be possible. So in a situation of financial distress, then basically this positive NPV project will have a positive impact on the bondholders, and this positive impact on the bondholders actually reduces the degree of benefits for the equity holders, and then can basically make this unattractive for equity holders. And let's see the example here. Again, it is a very, very simple and easy play of some numbers. If you go to the academic literature, of course, you have nice mathematical models, with continuous functions and with lots of assumptions and with a lot of mathematics behind it, but the basic intuition will not change. I like actually our textbook in that area because these easy examples give you the best intuition, and if you would make it a full-scale model with nice mathematical complexity, you don't get really additional insight. It just looks more elegant and more academic. But this is really enough. So again, we turn back to our company, Baxter. It does not pursue the risky strategy. So 900 is the outcome at the end. But they have an investment opportunity. It requires an investment of 100,000 and will generate a risk-free return of 50%. This looks almost not like a miracle. Of course, you should do it. If you have if the current risk-free rate is 5%, and of course you make lots of money, and you understand, and of course you say this is so wonderful. Why should I refrain from doing this? But Baxter, of course, in this situation, doesn't have any money on the hand. Suppose this is this 900 of asset. This is a machine, basically, that will be worth 900 at maturity. And of course, we have this debt equal to 1,000. And we actually have negative equity, basically. This is the situation of the firm. If there is no cash on the hand, of course, Baxter would need to raise 100,000. The only way to finance this is by raising capital. You may think about, well, you can finance with new debt or with new equity. In that situation, probably you can't get any more debt, because the bank will say, you look like almost bankrupt. Why should you ask for new debt? So we assume that must be equity finance. And if you think about whether it makes sense to make the project, without the new project, the value will stay. This is the total firm value, but your debt will suffer. There was only 900. No equity. This is how the firm looks like. And of course then, in this example, the firm will just leave nothing for the equity owners. So in this assumption, this debt of 900 and this assets of 900, and these assets are risk-free, there is nothing left over for the equity owners. Now, the new project would have a cash flow of 150, and you invest 100, and you get 150. So the total firm value will be 1,050. But okay, of course it was still correct. The debt has a face value of 1,000 as before, so it would be 50 left for the equity owners. And now, of course, the equity owners basically think, I have to inject 100 into the firm, I get only a benefit of 50. Why should I invest 100 to make this happen? If they realize this wonderful investment project, they basically benefit not for themselves. The main benefit goes to the debt, because the debt now goes from 900 to 1,000 in value, and the equity only goes from 0 to 50, not enough to break even on the investment. So you must pay 100,000, but you get back only 250,000. That is a situation where the current capital structure basically incentivizes you not to do the project. When I wrote my PhD thesis, I thought, or I did research about the advantage of having a bank vis-a-vis a bond holding structure. If you compare a bank loan with a bond, the main difference is a bank loan is like a bond, but it's held only by one investor, and this investor is the bank. A bond is thousands of different people. If you think that the contract is the same, if you pay some money, and then at the end you have a fixed repayment of 100. That could be a bank loan, that could be a bond. But with a bank, you have only one contractual party. Now, if you're in that situation, and if you think that debt is one bank only, then you would go to the bank and say, dear bank, look, this is the situation. We have a wonderful investment opportunity, but I have no incentive to do this. Let's agree on something to make this happen. The two together, of course, benefit from doing the investment. If you can sit together with the bank, you will basically change the contract and make it happen. Maybe you tell the bank, please, let's change the contract and let's have a mix of debt and equity for the bank, so the bank becomes an equity owner, or let's do something else. It is very clear that money is left on the table. So if you can sit together and negotiate, you should be able to find some solution. So my dissertation theory was basically, if this kind of situation arises, if you have a bank with which you can contract, you will renegotiate the contract and you will make sure that you don't suffer from this debt rate loss. Why should two people basically leave the money on the table if they can talk to each other and if they have symmetric information? Only if you have many, many bondholders, and if you find it difficult basically to propose a renegotiation agreement that all bondholders agree to. You can ask the bondholders, do you voluntarily change your bond to a new contract? And the new contract basically then makes the project profitable for both. But if the bondholders basically say no, like in the Grossman-Hart model, which is the optimal for bondholders, for every individual bondholder to say no, then you can't really negotiate. So if you think deeper, the structure is a bit more difficult. You have to think about why the debt contracts cannot be renegotiated. We basically assume that there is no communication between debt and equity, that the contracts are fixed, and basically that the equity owners can make the decision without talking to the other party. And there's a rather special kind of thing. It seems sensible to assume this if you think about many, many bondholders, where negotiation is impossible, but it does not make a lot of sense to think that if you have only one bank as a partner, that you would basically not find an agreement to realize this wonderful investment. Yeah, so what are the overall conclusions of this? Agency costs basically are, when we talk about agency costs, when shareholders or managers have incentives to do things that are not in the interest of the overall society. Yeah, their action affect the value of the debt, and of course they think only about the value of the equity. And that brings us incentives to where shareholders can benefit at the expense of the debt holders. The shareholders, although they ultimately bear the cost of this, because debt holders will adjust the terms of the loan contract by anticipating this. This is nonetheless a debt-weight cost. So if you are here in a high debt situation, it is highly likely that the firm suffers from this kind of behavior. So if you go back with the leverage ratio, that will improve the situation. So agency cost basically is a cost that when the firm's leverage is increasing, that if the firm capital structure is basically changed from year to year, the value of the firm should increase. Okay, now basically we had two arguments to argue that if you reduce leverage from a high value, this was basically underinvestment, and this was gambling or excessive risk taking. Both arguments basically tell you that if you're in a highly leveraged situation, you basically are not in an optimum. By reducing the leverage ratio, then you can prevent these kinds of costs and you increase the value of the firm. Now we basically do the opposite and basically argue that if you're in that situation, agency costs can actually increase the value of the firm. Agency cost up to now is something that basically is a real cost of leverage. So if you have too much leverage, you should reduce the leverage. And we think about the trade-off of the tax benefits, and this is actually agency costs. But if we think about the value of leverage in terms of agency costs, we basically think that having more leverage makes sense also from an agency cost perspective. Let's think about the underlying. When a firm adds leverage, so it goes from here to here, could that be something that is beneficial? Sorry, this is the old slide. The agency benefits of leverage arise in a situation where basically managers make decisions on behalf of themselves and not in the investor's interest. So think about these two agency conflicts between managers and shareholders, and between creditors and equity holders. Up to now, we were in this area. We thought about somebody like Elon Musk and the bondholders. Now we also think about managers and shareholders. Entrenchment is a word, basically an American buzzword, meaning that managers maximize their own welfare by driving expensive cars paid by the corporation, or even have an airplane sponsored by the corporation. And so they're basically taking shareholders' money in order to have their own fun and pleasure, and that is called entrenchment, and that's clearly not in the best interest of the shareholders. Yeah, one example from Google, Sergey Brin and Larry Page are the two founders of Google, and they decided to hire a Boeing 767. Yeah, and they didn't pay for by themselves, which is basically their private airplane. They use it for flying wherever they want, but it was paid by Google. And if you're a Google shareholder, you basically pay this plane. Yeah. And clearly, that the shareholders were upset, and they said, no, this is not what we expected. Yeah, we want these two guys to work and not to use our money to have an airplane, and such a big airplane. That's a bit too much. And they sued, and the court basically said, no, this is allowed. Yeah, when managers decide to use such an airplane, the managers run the firm, they decide how to use the money that the firm has. And if they decide this firm needs a large airplane for the managers, then they can do this. So this is a classical example of management entrenchment. By the way, Sergey Brin and Larry Page are of course also Google shareholders, but as I told you yesterday, they have lots of control because they have 10 voting rights, but their equity share is very small. Google is a company worth, I don't know, 400 billion or so, or just another 1,000 billion. They may have 1%, which is still 10 billion rich people, but it's only 1%. So if they own 1% of the shares, basically they enjoy 100% of the airplane, but they pay only 1% of the price. That is basically what American finance professors find very, very annoying. If you have all the benefits, you can travel now in your own corporate jet, and if you pay only 1%, it's obvious that you choose an airplane that is too expensive, too big. And then, of course, the professors think, what can restrict the people from doing this? And the idea is very simple. If you have a lot of debt, and you buy a large airplane, you may go bankrupt. And people just stop from doing this simply because they are afraid of bankruptcy. It's very that simple, the story. So, as a benefit, if you go from here to here, the debt is increasing, the firm value is also increasing, simply because Larry Page and Sergey Brin decide, oh, let's better have a more modest airplane. And the shareholders say, great, this is what pleases us a lot. Our share price goes up. So it's a reduction of wasteful investment. That's at the core here. The assumption is that managers have incentives to do wasteful investments. Obviously, the net present value of this investment is zero, and then it's negative from the viewpoint of the shareholders. The benefit is only small. Small airplane to do the same thing. So basically, it's a waste of money, and therefore a destruction of firm value or of shareholder value. Some people call this empire building. An airplane is just one element of an empire, and you could think of many more things that corporations do. And the airplane is, of course, a nice example, but there are academic studies that basically try to look inside the firm and basically try to estimate how much of the investments of these firms basically are done only because managers enjoy this, and basically they say that could account for large amounts of money. So that could be really important. So there were all kinds of things, not only the airplane. Maybe managers prefer to run larger firms compared to smaller firms, and maybe they just invest money in order for the firm to become larger. And although the net present value is zero, they nonetheless do it because they have a private benefit from this. There is evidence that if you run a large firm, you tend to receive higher salaries. Maybe another reason why managers love size. I actually think it's not the same way. Look at the Time Warner case. The reason why Time wanted to buy Warner and become larger is to prevent being taken over. Sometimes you do a bad investment. The acquisition of Warner was clearly bad for Time. It reduced its share price, and the main reason was just to prevent being taken over. This is another kind of mistake. And the idea is, if you have more debt, you are less likely to do it. Think about Time Warner. Time, because the shareholders didn't want Time to merge with Warner, they basically said, you don't approve the capital increase. You must pay with cash. If Time would be in a situation with high debt already, it would not receive the cash from the bank. So only if you have very little debt, you can basically go to the debt market and raise a lot of debt, and then acquire Warner. So the idea is that if you have a good capital structure, a good amount of debt on the equity, on the balance sheet, this kind of bad behavior, like acquiring Warner, is basically impossible. Paying too much for acquisitions, making unnecessary capital expenditures, hire unnecessary employees, or of course buy an unneeded largely uptrend. These are all examples of wasteful investments. This is just another example. I guess over it. This is another case from Germany. Bayer is our largest chemical firm in Germany, and they paid 63 million to acquire Monsanto, and the share price of Bayer since that has only been falling. The total value of the firm is now much less than 63. After merging with Monsanto, they were at 120 or so. Bayer and Monsanto had roughly the same size. So the overall firm was trading at 120 million market cap, and this turned out to be a disaster. Today's market cap is something like 40. And the people basically asked me why. Was it just bad luck, or was it really a bad management decision? And many people basically think that it was a bad management decision, and that if Bayer could not have bought this firm, if it would have been in a situation with a high amount of debt. Bayer was here, and after the acquisition it was here, because the acquisition of course increased the debt significantly. If Bayer had more debt upfront, this transaction would not have been possible. And if you believe that the self-interest of management basically wrongly or badly incentivizes management to do these kind of transactions, then basically you try to stop this by having more debt. So if the shareholders anticipate this, they would simply ask the manager, please use a good leverage. You are fired if you don't go to this debt level in order to prevent takeovers like this. Of course, we know that this takeover was a disaster ex post. We don't know whether ex ante it was also visible to be a disaster. Maybe initially this was a good idea. And of course we also know that if we are here in a rather high debt situation, and if we would take over that creates value, of course many takeovers, takeover can destroy or create value. If there were high synergies, incentive shareholders want the takeover to be realized. If there were, if this is an empire building thing, of course shareholders wanted to prevent this. With the debt level, they basically made all takeovers less likely. So it has benefits as well as costs associated with it. So that's the share price after the acquisition, and it has been falling since then. That's the share price. Oh, I think it's the market cap. Let's have a look. we have to look at this. In 1780. So here roughly was made the decision to acquire Monsanto, and this happened afterwards. The share price fell from something like 100 to now 30 or so. If you were a shareholder, you will be really upset. Yeah? And this is in a time when the stock market overall went up. If you just bought the equity index, the DAX, you would have almost made 50%. And now you lost basically a lot of money. So, of course, we don't know whether this was empire building from the first day on. Yeah? Another example of where people say this was empire building was when Daimler acquired Chrysler. I talked to you about this. Chrysler was an American large car manufacturer. Daimler, the prestigious producer of Mercedes-Benz cars. Extremely profitable, Mercedes-Benz. They had huge amounts of cash. They didn't know what to do with it. They didn't want to pay it out for shareholders. And basically said, let's acquire Chrysler, build a globally operating large car manufacturing firm, and it ended again in complete disaster. This Harvard Business article basically said because the organizations really didn't like each other, the culture was extremely different, they couldn't cooperate, and they basically never integrated the operations, and therefore the synergies that were initially expected never realized, and instead basically they made wrong decisions at Chrysler. And if you believe the takeovers are quite often of this kind, then you say, why do they happen? And you say, it is only because the companies have little debt and a management that likes to have a large firm and to have an empire. These companies have too much cash and too much debt capacity. If you acquire a large firm, like Monsanto or like Chrysler, you need a lot of money on your cash balance, and you need a lot of money from the banks. And if you have already, if you paid out the cash as a dividend or for share repurchases, if you increase the debt level already before, then this is simply a no-go zone. So debt is basically a disciplining device in order to prevent this. So if you believe that managers might overinvest because they are overconfident, or maybe because they are too optimistic, or they are empire builders, they want to make an empire just for their own reasons, then they may have only mistakes, but they basically tend to make bad decisions, non-value creating acquisitions. And the free cash flow hypothesis, which is a very famous word, free cash flow, you learn from valuing firms, the free cash flow to firm valuation, but that's a completely different thing from the free cash flow hypothesis. Don't confuse these things. This is the famous word generated by Michael Jensen, the one author of the article just cited. Basically, Michael Jensen wrote another article called the free cash flow hypothesis, and he basically argued if managers have too much money and cash, if firms have too much debt capacity, don't be surprised that they do all kinds of things that shareholders actually do not benefit from. And these are just examples. So after realizing, of course, positive NPV projects are the projects that everybody wants to be realized. But if there is cash left over or debt capacity left over, then managers may use that cash in order to do more acquisitions, and by definition destroy value. We don't know where exactly the point is. We can't basically tell what acquisitions destroy value or what kind of investment projects destroy value, but we deeply believe that those firms that simply just by luck, Mercedes-Benz was just by luck the most profitable car manufacturer of the world. And they had so much profits that they surely did all the positive value investments, and then probably also a lot of additional investments on top of this. Yeah? So when cash is tight, of course, managers cannot do these investments. Yeah? And when cash is tight, basically you always run the risk of bankruptcy. Yeah? And therefore, you always fight for survival. Yeah? You invest very, very carefully, and make sure that the firm is run efficiently. Yeah? So the free cash flow hypothesis basically says that leverage increases the firm value. Yeah? So this is basically this kind of error. Yeah? If you have no debt at all, or only a few amounts of debt, by increasing the debt, the firm value will go down, simply because it commits the firm to make future interest payments, so the cash flow goes out of the firm to the capital market. There was less cash left over in the firm, and therefore less cash to do excessive or wasteful investments. People also argue that managers work harder if you have lots of debt. When the firm faces a high risk of financial distress, high debt level means you have to make high payouts to the debt every year. A lot of money needs to be paid out. Think about you have bought a house. You have a mortgage loan, and you think about, should I just be lazy in my job and risk to be fired? This will quickly bring you into bankruptcy. Simply because if you are fired, you can't no longer pay your loans. If you don't have a house, you may not care so much. Because if you are lazy and you are fired, you at least don't go bankrupt. So debt actually induces an extra penalty for not working hard or for doing excessive investments and all those kind of things. And then one other thing, if there was high leverage, I yesterday told you about the German house bank. German corporations quite often have only one bank that is really the central and important bank. And imagine Germany after the Second World War, it was destroyed, as was Vietnam after the war. All people were poor, so the successful entrepreneurs that built large companies basically didn't have a lot of equity. A lot of growth was financed by banks, so we had lots of leverage. And the bank was basically taking high risks, but they also were closely what the managers would do. So if a bank is the main financing party of a large factory, of course they closely watch, and if they see, somebody buys an airplane, or somebody does risky investments, and the bank will immediately say, no, let's talk about this. Let's stop this kind of wasteful behavior. And then, so the benefits of having debt are really plentiful. There are many different advantages. Sometimes we don't know is it really an advantage or a disadvantage. Because if you say high debt makes it impossible to do a big takeover, then of course you also miss the value increasing takeover. So you don't know ex ante. But there were many beneficial kind of things, and therefore, people say, in an area with too little leverage, you should increase leverage, and if you have too much, of course, then you have all kinds of other agency conflicts. And so we talked about many different stories, and the key question is then, what do researchers or finance professors today believe are the most important ones? And most professors are convinced that these agency costs play a much bigger role as compared to the tax benefits and to the bankruptcy costs. Traditionally, we mainly focused on bankruptcy costs and tax benefits of debt, and they are easy to calculate and they are obvious and evident. But most people believe that the real world is much more driven by these kinds of agency conflicts. And they are more important, they are difficult to estimate. We can't simply observe some numbers and then estimate the amount of agency costs. and basically say a reduction or increase in leverage would be beneficial or harmful. Yeah, but we deeply believe that these kind of concerns play a much bigger role in finding the optimal capital structure of a firm as compared to other things. And the main reason is that if you look at different countries with different tax rates, we don't see that high tax countries have higher debt ratios. So the tax shield of debt doesn't seem to be the most important thing. What we do observe is that when private equity firms take over companies, if a company like Bayer or like Mercedes-Benz should be taken over by private equity, then of course these firms quite often increase dramatically the amount of debt. And these firms seem to believe that this is beneficial for them. Private equity firms are extremely professional people, and at least they prefer a much higher debt level, and that makes professors believe that if the manager can run the firm himself and decides to have a very low debt level, that this is basically the result of managerial preferences and not of capital market investor preferences. But again, always keep in mind things are much more complicated. If you have a private equity firm, and if the leverage comes from one bank, then basically you have only two parties. And you have one bank and one very professional investor. Both the bank and the investor will closely monitor the firm, will have all the information, and whenever there is a problem, they can sit together and bargain. And they can rewrite the contracts and restructure the whole thing. And that is completely different to a firm with thousands of shareholders and thousands of bondholders. In that situation, the shareholders and the bondholders will not negotiate. If there is an agency conflict, the manager will simply exploit the opportunities and engage into wasteful kind of things. If you have few parties, you should think that the parties basically monitor the thing, realize the problem, and find some way to solve it. And that's why the reason why this theory is good. I think it's good to describe the problems of a large public corporation that has many shareholders and many bondholders. It's probably not the appropriate theory when you think about a firm like the Wind Group, VinFast and so on, or if you think about Tesla, where you basically have only a few key players. Elon Musk is the biggest shareholder, and I don't know what the debt situation is. Tesla is a bad example, they don't have a lot of debt. If you think about something like Tesla with a lot of debt, and you think that this debt is basically controlled by one single large private debt fund or one big bank, then why should they simply wait and see how this airplane is purchased and so forth? Okay, so I think this is, only one more slide, and then we have a little break. If you think about what kind of conclusions can you draw from this theory, then unfortunately we cannot calculate the optimal debt level for a firm like Tesla or Mercedes-Benz, but we can basically say that R&D intensive firms typically, they have typically low debt levels, and the way how we interpret this, professors believe that what they observe somehow is the result of the wisdom of the capital markets. We deeply believe that if R&D intensive firms have low capital ratios, then there must be a good reason to do so. What we observe, many professional people interact with the capital markets, and hopefully they are intelligent enough to choose the right thing. And of course, with high R&D costs, these are companies that are not profitable. If you think about Mercedes-Benz, they're extremely profitable. Every year they earn billions of money, and then they don't know what to do with it, and invest it in the acquisition of Chrysler. This kind of problem simply does not exist. So the free cash flow costs of debt do not exist here. So there is no reason to basically increase the leverage in order to prevent this kind of cash flow spending. So this free cash flow theory explains why R&D intensive companies have low debt levels. And low growth mature firms, like for example Mercedes-Benz, they basically have very stable and high cash flows. They often carry high debt, and basically they are forced to take over to increase the debt, or they are forced by active investors. Or they basically say, if I don't have debt, it will be taken over. Let's think about the LBO example yesterday. High debt is a good protection against a takeover with an LBO. So these firms basically decide quite often to have a relatively high debt level. Mercedes-Benz was an exception. Mercedes-Benz was simply so large that there was no threat of a takeover. Nobody could take over this large firm. And basically that led to a lot of intervention possibilities of the management. So they may be the counterexample of this theory. But if capital market discipline works, if there is the threat of a takeover, then these companies basically decide to have a high debt level, and that basically forces them to pay out these cash flows to the capitalists. And then it is the investor's decision how to invest the cash flows, and not the management decision. In a situation where managers likely do bad decisions, that is the better thing. Many shareholders basically simply argue that if a firm like Bayer or Mercedes-Benz decides what can I do with my cash flows, I don't need it for my own business, it's mature, we don't have to invest into new machines, or we have lots of cash in excess of this. And then we think about buying Chrysler or buying Monsanto. The shareholders basically said, we know better how to invest our money. We can do this, our own decision. We can take the dividend that you pay us out, or the money that you pay us out, and then we decide whether to buy Chrysler. And it should not be you. Simply because you may have other objectives, bad incentives, and then better place the capital in the hands of the investors, than leaving it in the hands of the firms. So many investor campaigns, managers usually tend to think, I want the money in the firm, it gives me security, it gives me the option to buy other firms if I like to, it protects me against bankruptcy. Many managers actually prefer to have the cash in the firm, and quite often active investors, as they basically have been listening to or that have been reading all this literature, basically say this is a bad situation. We must force the manager to increase the debt level in order to enforce the payout of this cash into the hands of the investors. And I think a large part of the takeover waves has this as the predominant story behind it. If you think why does the capital market react positively to hostile takeovers that lead to high levels of debt? It's because they believe this is a true story. This happens quite often, and this will be stopped after the takeover. I think if many capital markets investors believe in that story, then you understand why the stock prices go up after a takeover. You may say it is synergies. Two companies simply become more cost efficient, and the stock price increase is coming from this reduced cost. But if you look at the history, there is not so much evidence that the costs are really reduced. I think it's often stated, but not the real issue. The stock market reactions are so strong that there must be something else going on. And Americans in particular, they believe that managers are selfish and self-interested and optimize only this. In our culture, we find this a bit strange, because we believe that managers are like soldiers or like politicians. They do whatever their job is. They try to do it in an honest way and not basically take the money and buy airplanes for it. So this is the typical American way to analyze things, and Americans simply assume the worst when it comes to humans and interpret the share price relations. What does the share prices interpret? yeah, the share price reactions basically are integrated differently. So when you see these share price increases after leverage increases, yeah, you may read between the lines if the analysts write about this, that this is what they believe is the true story. Yeah, of course, they are a bit more polite in describing this, yeah, but this is basically the prevailing theory. Yeah, and it has been, as you saw, it has been born in '86, yeah, so it's really only 20 years old. Yeah. The generation of managers that work today at Wall Street basically all have learned this kind of theory at the business school and basically seem to believe in the theory. Yeah. 50 years ago, nobody knew that theory, and the capital market basically was reacting completely different. And in 20 years from now, maybe another theory is dictating the capital market thinking. If you want to understand how corporations and how investors react to new information, how they decide on investment projects, that is of course influenced by what they learn at university. And these kinds of stories are simply the predominant stories that American students get to learn, and also European students, and that's why they shape our world. They shape our thinking, and they shape, at the end, basically how people behave and how stock prices react. And I personally think this is a very strange view of the world, because as a German professor, of course, I could simply say, if I behave like this, I simply stop working. Because I get my salary anyway. There is no duty for me to do anything. If I'm really an optimizer in that respect, I would simply stop working, or almost stop working. But of course, people don't do this. People do what they are supposed to do, although they don't have an individual benefit from this. And this is something that these theories completely forget. They believe that people are selfish, that they are empire builders, that they don't care about what the bond holders and the equity holders really want. And I find it a bit strange to be that, to have that kind of view. Okay, so let's have a 10-minute break. And 5 to 11, we restart.